According to Modigliani and Miller's dividend irrelevance theory, investors are indifferent as to whether they receive a dividend or capital growth in their share value, as they can manufacture their own dividend by selling shares. The question then asks which three of the following reasons undermine this theory in the real world. So essentially this is saying that shareholders don't mind what they get. If they get a dividend when they don't want it, they could reinvest that money to generate a capital gain, or if they got a capital gain and they wanted a dividend, they could sell some shares to manufacture their own dividend. But the question wants to know which three of these might make this potentially false. So first of all, share price will fall if no dividends are paid. This is probably not the case because as the dividends are not paid, that money should be reinvested back into the business and we should see an increase in that share price. The investor's ability to influence management will be reduced. This is potentially correct because this will reduce the proportional shareholding if shareholders have to sell their shares to manufacture a dividend. The investor is reliant on the cash dividend. This isn't a problem because if they are reliant on that cash, they can take some of those shares and sell them to self-create a dividend and give themselves some money. Transaction costs may apply when selling shares. Yeah, this is a potential problem. Modigliani and Miller assume there are no transaction costs, and if shareholders are having to sell some shares to create that dividend, then they are going to lose some of that value in fees. And then finally, tax planning will be affected. Yeah, this is a problem. Certain countries tax dividend income differently to capital gains, and as a result of it, shareholders might have a preference one way or the other. So here, the correct answer is B, D, and E.